I'm Cynthia Rowland, and this is episode 62 of EO Radio Show. In today's episode, I'm going to discuss the new proposed regulations regarding excise taxes on taxable distributions by sponsoring organizations of donor-advised funds, and the effect of these on certain fund managers that make these distributions. These new regs were dropped on Monday, November 13th, and were officially published in the Federal Register on Tuesday, November 14th. So this is earth-shaking news for the charitable sector, and I'll go over some of the reasons why in this episode. These proposed regs provide guidance regarding donor-advised funds and taxable distributions from them. The proposed regs generally apply to certain organizations, including community foundations and many other types of charities that maintain one or more donor-advised funds. And they also are important for persons involved with the donor-advised funds, including the donors, the donor advisors, related persons, and certain fund managers. So for context, the Treasury report provides some statistical information from IRS statistics that it has gathered for 2019. So the statistics are a little bit old, but they do give you a good range of the context for these regs. There were more than 1,300,000 active nonprofit charities in 2019, of which more than 1,600 were self-identified as sponsoring organizations of donor-advised funds. And they reported around 1 million donor-advised funds in that year. So that's a lot of interested parties. In this episode, I'm going to go through an overview of the basic rules that apply to sponsoring organizations and donor-advised funds. And then in future episodes, I'll go into the details of these proposed regs. So listen in for some overview information about these new rules and how they will apply to charities. Welcome to the EO Radio Show, your nonprofit legal resource. Brought to you by the Exempt Organizations Group at Farella, Braun & Martel. My name is Cynthia Rowland, and I'm a partner at Farella. I'm a business and tax lawyer with more than 30 years of experience advising clients on nonprofit and charity law. Through this podcast, our lawyers and guests will discuss a range of legal and business issues impacting the nonprofit world because we understand you work hard every day to make your community a better place to live and do business. Many of our programs focus on the basics, and at times we'll do a deep dive into narrow and complicated legal issues. Again, welcome to the EO Radio Show. We're glad you're here. In today's episode, I'm going to give an overview of the new regulations under 4966 of the Internal Revenue Code. I'll have links in the show notes to the actual proposed regulations and additional resources on donor-advised funds. These new regulations under the Treasury regulations numbered 53.4966. There are 5 subsections to that. 4966-1, which fills in some blanks on the definitions that are relevant to defining a donor-advised fund. 4966-2 goes into some detail on the calculation of the taxes paid on taxable distributions. 4966-3 puts a lot of flavor on the definition of donor-advised fund. 4966-4 goes into the exceptions to the definition of donor-advised funds and covers the statutory exceptions and adds 2 new exceptions under the regulatory authority provided in the Internal Revenue Code. And then 4966-5 provides new rules on when a distribution from a donor-advised fund is deemed a taxable distribution from the donor-advised fund, which thereby generates the excise tax on the sponsoring organization and the managers. That's 5 new regulations, and each of those regs have a number of subsections and go into great detail. But before we go into the overview of those proposed regs, I'd like to start with an overview of the basic rules that apply to donor-advised funds and sponsoring organizations. And then in future episodes, I'll do a special episode just on the definition of donor-advised funds and fund advisors. And another planned episode is on the exceptions to donor-advised fund rules. And then I'll do a final episode on these regs that discusses the taxable distribution rules that are elaborated on in 4966-5. So here's the basic overview. For those of you who are already very well versed in the statutory structure that governs sponsoring organization and donor advised funds, you might want to skip ahead. For those of you who would like to get a general overview of the Internal Revenue Code regime that applies, here are the basic rules. So charitable organizations, most commonly community foundations, but there are now many, many different types of sponsoring organizations. These organizations establish accounts to which donors may contribute and then provide non-binding advice or recommendations with regard to the distributions from that account, or they can give advice on the investment of assets in the account, and sometimes both. These accounts are commonly referred to as donor-advised funds, or DAFs. These have been in existence for many, many years, but they began to take a framework in the Internal Revenue Code in the Pension Protection Act of 2006. So in 2006, the Pension Protection Act enacted various amendments to the Internal Revenue Code that defined DAFs for the first time. Among these rules, the Pension Protection Act amended 4958 of the code to add special rules relating to excess benefit transactions between donor-advised funds and certain fund advisors and other interested persons. 4958, as you'll recall, is the general provision that applies to insider transactions between public charities and their insiders. The Pension Protection Act also added Code Section 4967 to the Internal Revenue Code, and that one imposes an excise tax on prohibited benefits resulting from distributions from DAFs. Section 4966 of the Internal Revenue Code was also added by the Pension Protection Act in 2006, and that section imposes excise taxes on taxable distributions made by the sponsoring organization from a donor-advised fund, and also imposed penalty taxes on certain fund managers related to the making of those taxable distributions. So these proposed regs only address 4966 of the Internal Revenue Code. To go into a little bit more flavor of the statutory structure, I think it's important to talk a little bit about these several provisions, 4958, 4966, and 4967, as they exist in the Internal Revenue Code. So as I noted, 4958 imposes an excise tax on any excess benefit transactions, which means any transaction in which an economic benefit is provided, the value of which exceeds the value of any consideration received by an applicable tax-exempt organization, directly or indirectly, to or for the use of a disqualified person with respect to the transaction. Now, that's a lot of statutory terms, and each of those terms has specific meaning under the code. What's important to note here is that the excise tax under 4958 is paid by the disqualified person, that is the insider, who benefits from the transaction. Then there's a separate excise tax paid by the organization managers, that's the individuals, not the organization. This separate excise tax paid by the managers is imposed on any organization manager involved in the transaction, knowing that it is an excess benefit transaction unless the manager's participation was not willful and is due to reasonable cause. So the Pension Protection Act amended Section 4958 to provide that with respect to any transaction that involves a DAF, a disqualified person is specifically defined to include any donor with respect to that donor-advised fund, any donor advisor with respect to that donor-advised fund, and any member of the family or 35% controlled entity of the donor or donor advisor or member of their family with respect to the DAF. These persons are defined as related persons under the new rules of 4958, or I should say the then new rules in 2006. The 4958 rules also specifically provide that any grant, loan, compensation, or other similar payment from the donor advised fund to one of these disqualified persons is an excess benefit transactions. For purposes of this special rule for transactions involving DAFs, the excess benefit includes the entire amount of the grant, loan, compensation, or similar payment, without regard to whether it's a reasonable amount of compensation or any other justification. So it's a very strict rule. The Pension Protection Act also amended Section 4958 to treat as a disqualified person with respect to a transaction involving a sponsoring organization. So it includes an investment advisor or family member or 35% controlled entity of the investment advisor. So the upshot of that was that 4958 dramatically increased the number of persons as to which this stringent penalty tax could apply in the context of donor-advised funds. So that's 4958, a very stiff penalty on certain individuals. 4966, which was also added in 2006, first defines a donor-advised fund. It defines a DAF generally as one that meets the following characteristics. 1, it's a fund or account that is separately identified by reference to a contribution of a donor or donors. 2, that is owned and controlled by a sponsoring organization. And 3, with respect to which a donor or any person appointed or designated by the donor, referred to often as the donor advisor, who has or reasonably expects to have advisory privileges with respect to the distribution or investment of amounts held in the fund or account by reason of the donor's status as a donor. So 4966 has a couple of exceptions to the definition of a DAF. The exception to a DAF is a fund or account that makes distributions only to a single identified organization or governmental entity. And the second statutory exception is a fund or account with respect to which a donor or donor advisor provides advice regarding grants to individuals for travel, study, or similar purposes. Then 4966 in the subsection referring to exceptions also authorizes the Treasury to exempt funds or accounts from treatment of DAFs if it's advised by a committee not directly or indirectly controlled by the donor or any donor advisor, or if it benefits a single identified charitable purpose. That's the general framework of 4966 in the statute. The statute also defines sponsoring organizations and also sets forth the specific calculation of the excise tax on a taxable distribution that violates the provisions of 4966. That excise tax is 20% on each taxable distribution, which is payable by the sponsoring organization with respect to the DAF. So the funds to pay the excise tax are paid by the charity that sponsors the DAF. There's also an excise tax on the fund manager. So there's a 5% excise tax on the agreement of a fund manager to the making of a taxable distribution, knowing that it is a taxable distribution payable by the fund manager who agreed to the making of the distribution. So you can see from 4966 that there's a strong incentive on the sponsoring organization and its fund managers to make sure that distributions made out of a DAF do not violate the rules. So then to close out the overall statutory structure, there's Internal Revenue Code 4967, which also came in 2006 with the Pension Protection Act. Section 4967 imposes a separate excise tax on advice that a donor, donor advisor, or related person provides regarding a distribution from a DAF that results in such person or any other donor, donor advisor, or related person receiving directly or indirectly a more than incidental benefit. This excise tax is paid by the donor, donor advisor, or related person who gives the advice to the sponsoring organization as to the distribution that violates these provisions, or if that person, him or herself, receives the prohibited benefit. Again, there's a separate excise tax under 4967 as well, which is paid by the fund manager. This tax is imposed on the agreement of any fund manager of the sponsoring organization to the making of the distribution when that fund manager knows that it would confer a prohibited benefit. So that's 4967. In today's episode, I'm going to give the overview of these new proposed regs, which are only on 4966. These proposed regs do not directly address 4958 or 4967, but I think it's important to keep in mind that it's a bigger statutory structure, and the provisions in 4966 are important to those other provisions because they provide some important definitions that are really important to the other provisions as well. From here on out, I'm going to go through a quick overview of what the proposed regs do cover. And then in the future episodes, I'll go and take a deeper dive into all of these areas. So the proposed regs under 4966-1 provide that a DAF generally means a fund or account, number one, that is separately identified by reference to contributions of a donor or donors, that is owned or controlled by a sponsoring organization, with respect to which at least one donor or donor advisor has or reasonably expects to have advisory privileges. So unless otherwise accepted, a fund or account that meets all three prongs of this definition would be a donor-advised fund for purposes of these Internal Revenue Code provisions. So the proposed reg does address, one of the simpler pieces, the definition of a sponsoring organization. In the proposed regs, the sponsoring organization is proposed to be defined in accordance with the statute as any organization described in 170C, other than a governmental unit, although it doesn't have to be an organization created or organized in the United States. So it can be a foreign organization, can be a sponsoring organization. Secondly, the proposed regs provide additional rules for the second prong of this, or the first prong of the test, that is, separate identification by reference to contributions of a donor or donors. The proposed regs provide a facts and circumstances test that various facts and circumstances that are relevant in determining that a fund or account is separately identified by reference to contributions of a donor or donors. So these facts and circumstances tests are new and they're very interesting, and they specifically provide, among many other things, because private foundations and disqualified supporting organizations could use a DAF to circumvent the payout or other requirements. The proposed regs don't exclude private foundations or disqualified supporting orgs from the definition of a donor. So anyway, in a future episode, I'll go into more detail on the proposed regs and their analysis of the separate identification by reference to contribution of donor or donors. The third prong worth talking about in this section, in the definition of what is a donor advised fund, is what it means for a donor or donor advisor to have advisory privileges. The proposed regs generally provide that the existence of advisory privileges, again, this is going to sound familiar, depends on the facts and circumstances, including the conduct and any agreement or understanding of both the donor or donor advisor and the sponsoring organization. However, the proposed regs do provide 4 special rules relating to advisory privileges. And again, I'll go into those special rules and the definition in the future episode, hopefully which will be published next week. The definition section also gives flavor to the term donor advisor. And the proposed regs include 3 special rules with respect to donor advisors and who meets that criteria. The definition regulations also include some significant information on when they would regard service on an advisory committee of a sponsoring organization, which advisory committee advises as to distributions from or investment of assets in a DAF when the participation on one of those committees causes a person to be treated as a fund advisor. The proposed regs provide 2 special rules relating to advisory privileges that arise from service on an advisory committee. Under these special rules, a funder account could be advised by a committee that may include 1 or more donors, donor advisors, related persons, or persons recommended by the donors. And in some circumstances, the way that advisory committee is put together will allow the DAF to not fall within the definition of DAF. So these are very interesting rules. And again, I'll go into all the details of that in the next episode. So an important part of these new proposed regs is the clarification and additional rules on the exceptions to the definition of a donor advised fund. So in future episode, I'll go into the details of these proposed exceptions. There are basically 4 now that are covered in the proposed regs. The 2 statutory ones that were already in the Internal Revenue Code 4966. And those are a funder account that makes distributions to a single identified organization. That's one exception. Second exception is certain grants to individuals for travel, study, or other similar purposes that meet the requirements of the statute. And then in addition, under the discretionary authority granted to the Secretary of the Treasurer to exempt other funds or accounts from the definition of DAF, the proposed regs add 2 exceptions to the DAF under this discretionary authority. One is an exception for disaster relief funds, which are consistent with the exception originally set forth in previously published guidance, and also an exception for certain scholarship funds whose committee is nominated by a 501c4 organization with a broad-based membership. So those are 2 categories of funds that will not be treated as donor advised fund if they meet the criteria in these new proposed regs. Finally, the last area I want to touch on is the proposed reg under 4966-5 on taxable distributions. And again, I'll go into more detail in this in a future episode. But for now, remember the general rule of 4966 about what constitutes a taxable distribution. Taxable distribution means, obviously, any distribution to a natural person or to any other person, second prong, any other person, unless the distribution is for a charitable purpose and the sponsoring organization exercises expenditure responsibility. The statute does accept from taxable distribution any distribution from a donor-advised fund to a charitable organization other than certain disqualified supporting orgs. It's also, of course, a distribution from the fund to the sponsoring organization is not a taxable distribution, nor is a distribution to any other donor-advised fund at another sponsoring organization. So the proposed regs incorporate this statutory definition, and in addition, they set forth some anti-abuse rules. The proposed regs also define the term distribution very broadly. These discussion and analysis of distributions is very enlightening, and I'll go into that in more detail in the future episode. So that's all for this episode. Stay tuned for future episodes diving into deeper analysis of these new proposed regs. I'm Cynthia Rowland, and you've been listening to EO Radio Show, your nonprofit legal resource brought to you by the Exempt Organizations Group at Farella, Braun & Martel. Farella also now has several YouTube playlists that organize the podcast episodes by interest areas, so be sure to look there for episodes applicable to your interest areas in the legal world of nonprofits. As always, if you have suggestions for topics you would like for us to discuss, please email us at eoradioshow@fbm.com. That's eoradioshow@fbm.com. Thank you for joining us. Until next time, make a difference.